The U.S. published its non-farm payroll data last week, and the number was not as optimistic as projected. April's non-farm payroll was much lower than expected. It was estimated employment numbers would hit 1 million, but the actual job number was only 266K, while the non-government sector job number was only 218K. The unemployment rate also increased to 6.1% instead of falling to 5.8% as expected. And when adjusted for those who had dropped out of the labor force, the unemployment rate was nearer to 8.7%. If the U.S. was to hit its GDP target of 7.7% for this year, unemployment rate will have to drop to 4.3%. These data made it much easier to argue that enhanced unemployment benefits by $300 a week in March's relief bill has resulted in more people not going back to the workforce. What do these numbers and the continuous money printing from the Biden government mean? We reference history, and in the 1970s, the great inflation during the Nixon government resulted in an almost 20% inflation rate in the United States, surging gold prices, job loss for millions of workers, and stagnation. Treasury Secretary John Connally, appointed by Nixon, who had no economic background, later declared personal bankruptcy. These memories are still vivid to us. Back then, most economists would argue that the U.S. did not export much inflation to other countries. However, with globalization process post-1970 and through international trade conducted in dollars, the U.S. has effectively exported their dollars abroad, leading to inflation in foreign countries and a net inflow of goods to the United States. This is good for the American consumer, but at the long-term expense of the countries which export to the U.S. China is one of the biggest trading partners of the United States, will surely feel the impact, but luckily the Chinese economy is recovering well post-COVID-19, and with its dual circulation plan, which looks to boost domestic consumption while avoiding relying too much on its export-driven economy. America's unprecedented $1.9 trillion stimulus plus $2 trillion infrastructure proposal by the U.S. government will cause a huge asset price increase domestically for sure. And with the green energy and carbon neutrality goals, the industry upgrades will further push up commodity prices like what is happening now. Copper price, for instance, increased 11% in Q1 and are expected to further increase in the next half of 2021. The worst-case scenario is the U.S. continues to pump cash domestically without a real economy returning, and employment numbers surging as a support, and the tax increase bill didn't get through. Then stagnation will be unavoidable. Biden government is well aware of this risk, but with an unprecedented divided America now, he has to prove his government is effective, while leaving the risk of a potential financial crisis and a deep recession before 2024. The result will be the world paying for the reckless action by Washington, D.C., and within the U.S., the wealth distribution will be further polarized. After the 1970s, most manufacturing jobs were moved out of the United States due to cheaper costs abroad. And while the country has the habit of blaming others for eating their lunch, it seems they are trying to avoid their own economic problems while eyeing other people's lunches earned through responsible policy planning and hard work.